Right, Mayuesh Joshi from Angel Broking now joins us. Mayuesh, would you buy into this fall on Infosys?
Afternoon, Pankaj. I think one really needs to wait and watch because the management commentary, I think, though sounded optimistic from a 2020 perspective, the entire perspective related to the next 3 quarters is going to be extremely paramount. Now, the management itself is not too sure how the Brexit impact might have the impact on the financials of the company and the IT sector as a whole. Couple that up with quarter 3, quarter 4 for the IT sector are traditionally weak. So you'll typically see the wage hike, the visa cost impact come through on the EBIT front. But on the Q3, Q4 aspect, I think it's going to be more on how discretionary spending is expected to come through. And again, being traditionally weak, I do not foresee, I think, any pickup probably happening in terms of a change in guidance post Q2. The soft conditions, the muted conditions for the IT industry might continue, but you might need to give a few days time. I think we really need to consider how the other IT companies are performing, and if the similar environment is looking a little bit soft and muted, you might have to revise your estimate downwards from an FY17 perspective.
Right, but how much do you think the downgrades would come and how much is factored in?
So largely, I think the most biggest unknown probably is the impact of Brexit, and that we'll come to know the next few weeks or quarters. If you leave that aside, I think you're probably going to see some amount of cushioning or softening happening specifically from the BFSI side, because I think a lot of banks probably are still going to defer or deter their decisions going forward. My own estimate is that whatever you're working out in terms of a dollar revenue growth, a constant currency revenue growth, that probably can get muted for the universe as a whole. So I think it'll be interesting to see what the different other IT companies are doing in the enterprise segment, in the IMS segment, and whether there is a general sense of weakness probably creeping in across these business verticals. And if that is the case, I think you will see that upgrades, and that can come down to any sort of a percentage, anywhere between 2 to 5% in terms of EPS downgrades.
Right, if we just look at the technology companies declaring numbers, Cyient lowered their guidance, it's down 5%. Infosys, of course, is a miss. TCS is a miss. NIT Tech is down 5% after numbers. You think overall technology, with this Brexit impact, with what's happening with various currencies, just stay away?
So at this point of time, I think we really need to analyze, as I said, different subsets within the IT sector itself and different niche segments that a lot of companies operate out of. But the general sense probably is that the environment might be soft going forward. And if that is the case, I think you're going to look at a muted volume growth come through. So the expectations of higher taking place in FY17 can get trickled down. The pricing pressures probably are not getting witnessed on balance sheets and as per management commentary as on date. But if there is some element of deterring or deferring of projects coming through, you might have some pricing element come through, and that is the risk that I probably foresee. So yes, I think let's wait out for all the companies to probably report the numbers. We'll get a greater picture on the larger landscape that the IT industry is operating out of at this point of time.
Right. Cox & Kings as a name has done pretty well from the levels of 150 back to the levels of 205.10. Would you be a buyer into Cox & Kings?
Again, largely I've never understood their business model very frankly. And again, it's a very complex business model to probably understand and analyze. So I think I'd best give it a go at this point of time.
Right. The idea is doing well from the levels of 100 to about 111 odd levels. Bharti is also up about 11-12 rupees today. Would you buy into telecom space?
No, largely I think if you put out a landscape over the next 3 to 5 years, and if one really goes for the argument for the telecom operators of consolidation probably coming in, by that time Reliance Jio would have come, the new plans would have come, there might have been some amount of moderation in terms of data tariffs if one really expects Reliance Jio to start with ultra reasonable plans. So in that case, I think over that landscape and that time period, you probably would have a lot of the earnings estimates getting downgraded built into the price. But again, I think largely the unknown in terms of how the leverage will pay out, specifically in relation to the 1700 megahertz band, which is having a spectrum band which is much larger than what telecom operators' appetite is at this point of time. That can probably push through on their balance sheets in terms of additional debt coming through. Secondly, I think even if you look at the core data operations, you're probably seeing the data revenue per minute actually coming down. And the other offsetting angle there would be increase in volumes. how that plays out is going to be interesting, extremely interesting, because I think the voice ARPUs are clearly showing trends of a declining downtrend. So in my opinion, I think to a large part of FY17, I think it's still going to be how the balance sheet issues are going to get played out, leverage probably increasing, debt to EBITDA levels getting higher, and that probably having a telling effect in terms of the overall return ratios. The only solace that you can probably have is that with the additional megahertz available by the government, you might have huge amount of spike through in terms of data volumes. But again, I think one really needs to wait and watch on how that plays out.
Right. As far as, we'll get Reliance numbers coming in today. You think that's a buy ahead of numbers, or irrespective of numbers, it's a buy?
No, again, I think I've always maintained this stance that Reliance, specifically in the oil and gas space, is not a quarter-on-quarter story to be played out with. Again, the company probably has done huge amounts of investments in the telecom vertical. 1.25 lakh crores already put in, expectations of another 25 odd getting by FY17. So you're probably looking at the telecom capex itself at 1.5 lakh crores. Now the core capex, a couple of projects have got delayed. So if you're talking about the PETGO gasification, the PX plant, I think that's probably getting delayed to third quarter FY17. So largely, I think once these plants start getting commissioned, fully ramp up probably fourth quarter FY17, you're probably going to see FY18-19 numbers in a much better shape for Reliance. So again, my entire hypothesis works that refining and petchem are the drivers for Reliance for the past couple of years, 3 years in fact. And again, I think they are going to be the drivers going forward. How much will telecom contribute? It is time that will decide, because I think the launch itself is expected over the next few months. And nobody's probably building in any revenue estimates from an FY17 perspective onto the book. So it's going to be performance specifically from petchem and the refining that is going to drive the earnings estimates. But again, I think with delay expected to come through and projects expected to ramp up by fourth quarter FY17, I think the numbers will be extremely visible and evident only from FY18 onwards. So I think it's a long drawn out story for Reliance.
Right. As far as ONGC, Oil India is concerned, is that something that you like? We've recently got news flow coming in about the kerosene deregulation.
So again, sentimentally positive in terms of these upstream players. But what really happens is with the deregulation that has happened on the auto fuels, entirely the story of ONGC and oil has become on how the crude pricing movement will be. Now, since they are extremely dependent on crude price movement, and we expect crude to probably trade in the range of $50 to $60, incrementally, I think I do not see any addition happening in terms of the bottom line getting readjusted or a re-rating in terms of the P multiples going forward. With kerosene probably getting hikes of 25 paise over the next few months, again, I think it will create some amount of an impact, 1% over FY17, around 4% on the EPS for FY18. But largely, I think that will not change the core dynamics of either ONGC or Oil India. My own estimates, as the management reports that I've been reading through of oil and gas production expected, and again the impairments that ONGC is particularly taken on its overseas assets on OVL, I think you will see some amount of pain still continuing on that front. So clearly, I think this is going to be a play on how Brent moves. Sentimentally positive, but it's not a game changer in terms of numbers coming through for FY17.
Right, but you would not want to buy into these names. I mean, they are valued attractively, but you'd see no reason for outperformance.
Oh yes, I think I do not see earnings upgrades happening. Yes, they are valued extremely attractively. If you talk about dividend yields, ONGC is giving you a dividend yield of 3%. You're probably getting Oil India's dividend yield at 4.5%. But that does not mean that the earnings probably is going to change in a jiffy for these companies. So the earnings might still remain muted for the reasons stated above. But clearly, I think if one is looking at a dividend play, I think they might become stocks that you can probably look at. But again, I think in terms of an addition probably in terms of rating for these stocks over the next year and a half, my presumption is I think the stocks are going nowhere, because I think it's going to go nowhere.
Right. How would you look at the high beta space? Let's start with the PSU banking lot. Do you think PSU banking would do well?
So largely over the last few weeks and quarters, I've always maintained that if one really needs to look at PSU banks, I think the larger PSU banks is something one can look at. The whole universe has probably moved. And again, I think the reasons probably are a little bit well known to the markets at this point of time. Markets are expecting recapitalization to come through anywhere between 10 and 20 odd thousand crores, and the recapitalization will be predominantly for the mid and small cap PSU banks. Having said that, probably on the asset quality front, the street probably believes whatever we saw in Q3, Q4 a lot of stability will probably come to numbers, specifically both on the GNPAs and net NPA sides. Provisioning will probably start coming down, and again I think that will have a telling effect in terms of how the credit costs pan out for the greater part of FY17. But largely my belief is Q1, Q2 will still be a little bit soft. There might be stability in a few PSU bank numbers, but the softness asset quality might very well continue over the next 2 quarters unless we see a sustained improvement probably in the credit cycle along with the capex cycle. My own sense is that the end working capital constraints that a lot of end user industries are currently facing might still plague balance sheets of PSUs. Again, I think valuations a little bit attractive compared to whatever the private sector banks are doing, but largely I think you must need and wait and watch for the results to come through. If there are disappointments on any of these counts, the rally that we'll probably see in these stocks might just fizzle out.
Right. As far as steel names are concerned, JSW Steel is buzzing. It's up 5%. It's closer to 1600 level. Tata Steel has gone back to the levels of 400, 500, 400 odd levels. How would you look at these names?
Again, largely, I think if you look at the domestic part of the story, specifically the steel story with the imposition of MIP and the duties that have got introduced, one really expects the end users to be realizations to probably go up. The volumes might pick up a tad bit as well, but the underlying factor again remains on 2 counts. One, I think, is the genuine demand coming back in a sustained fashion, or is it only a blip that we're probably seeing? Second, I think in terms of the international macro scenario on the Chinese demand supply situation, how is that expected to pan out, and what kind of an effect will it have in terms of the LME pricing? So I think all these factors need to be combined together. The domestic factors, in my opinion, still stand out, but again I think one really needs to understand whether the demand outlook by steel makers for the greater part of FY17 is held out, how the ramp up is happening in terms of their capacity utilization going up, and whether that is sustainable over the next 3 quarters. Because if that is the case, I think the fixed cost of production that the steel companies go through can clearly have operating leverage if they start utilizing their units at more than 80, 85 or 90 odd %. And if that does play out, I think that has a positive impact both on EBITDA per ton as the bottom line. But one really needs to wait and watch on the kind of numbers that they throw out.
Right. Mayuesh, thank you so much for joining us this afternoon. Hope you have a great weekend going ahead. 21 points down for the Nifty. Taking a break, coming back with market closing on the other side.